good. All good. Fantastic. Okay. Give another minute or so. We'll start at like 3 after, and then we'll go.
And then for the format, Nita, did you want to go through the presentation and then open up to open forum at the end? Does that sound good?
Yep. We'll leave. When we'll start, we'll give some instructions on what we'll do and things like that. But yeah, that's fine.
Perfect.
Mm-hmm.
Sounds good. Good. So 18. I know we have a couple of virtual note takers here. Perfect. A couple of reminder emails went out. So, and like just kind of remind anyone who wanted to refer some folks to check it out, happen to be on the road or it's inconvenient to do the registration. I did post the live stream link on YouTube. So once I get in, I'll show you the link to it. But if you search Dwayne, D-W-A-I-N-E, Clark on YouTube, as well as LinkedIn, and once you go to my profile, you'll be able to see it right at top. So it's all actively live streaming as we speak. Okay, perfect. Thank you guys again. I'm gonna check the Q&A. Okay, perfect. Okay. We're good to go. That sounds good.
All right.
Do you want me to load up the deck, or did you want
Let's
to
go.
All right, sounds good. All right,
Let's
gentlemen,
go.
ladies and gentlemen, let me load up the deck for you guys. Thank you again. I appreciate you taking the time. I know it's for some people it's a little later in the evening, some people West Coast, so I appreciate you taking the time from what you're doing to check this out. Let me share the screen here.
And what we'll do, if you guys have questions along the way, feel free to drop it in the Q&A. We will open it up for questions at the end. But feel free to drop in your questions as we go along. I'm sure there'll be a few.
Okay, 1 second. Okay, perfect. All set.
All right.
You have control over the deck as well. Let me know if it has any issues.
Okay. So welcome, everybody. My name is Nitsan Mosery. I have the pleasure of being here and hosting this webinar with Dwayne Clark. Dwayne and I, we go back, we've met each other a couple of years back at a real estate conference, and then we met up again at the Multifamily Inc. Accelerator weekend this past October, and it's been a pleasure working together. And today what we're going to do is this is, by the way, this is for educational purposes only. This is not a public offering. We're not offering an investment to anyone. So just be that known. We have to say that for the SEC compliance, and past experience does not mean future or present. Past returns doesn't mean future or present returns will have. So we just have to get that out of the way. We're not CPAs. We're not attorneys. We're real estate investors. So please, anything that you see here is for educational purposes only. And again, we're not offering any offering as of yet. We're just discussing a 218 unit property that we've had the pleasure of underwriting and evaluating and talking with the sellers and going forward, moving along the road on this. But right now, this is just for educational purposes to show you why we like these types of properties, how we choose areas and markets to invest in, right? We're going to talk about why Costa del Lago is an undervalued gem, how we underwrote the deal, returns, assumptions, risks, and things of that nature, what our plan would be in a property like this, because this is the mold. This is the bread and butter of what we do. And just to share with you, it's nothing out of the ordinary. This is something very, very simple and plain and everyday in the multifamily real estate world. What separates us from everyone else is the ability to dive into the markets, understanding the markets, the fact that we're hands-on operators. We visit our assets a lot, and we have an expert team that evaluates and helps move along the property while we're under ownership. We're going to talk about timing. What's going on now in the market and why now is the best time to invest, and how syndications work and what kind of investor this is for. So a little bit about me real quick. I've been in the multifamily space for the last 16 years. I've been in real estate a lot longer. That's me right there. And the top photo, that's the event that Dwayne was at. I think, Dwayne, you took that picture. You were sitting in that area, right? And the picture below is the event that we had in May. I've got around $200 million in assets under ownership. That includes 2 office complexes that I bought with my family, multifamily that I own, hotel, a glamping resort outside of Charlotte, and Class A student housing. I've had close to about 2,000 units owned in the past. In the last several years, we've sold them all. We've gone full cycle on many of them because it's been a seller's market. We're going to talk about different market cycles as well. We do underwrite very conservatively. We're known for that. I'm also a multifamily coach and educator and mentor. I love to help people achieve massive success. The team right now that we have together, we have an applied demographer. There's about 400 of them in the country. They study movements of people and demographics. So we have a demographer on our team that really can help us identify markets before they emerge. We have CFOs of Fortune 500 companies. We have investment bankers that have invested, worked on $8 billion worth of institutional investments with UBS. We have Dwayne Clark on the team as well, who's been in real estate, knows how to source off market opportunities. So we've got an incredible lineup of people behind the scenes working together to go out and to find, first off, the best markets to invest in, and then to source properties in those markets that have the best upside potential, where we can minimize the risk by doing due diligence, understanding market trends, and really seeing the value of the asset and moving along for the next couple of years on where that market and where that property is going. Let's see here. There we go. So let's quickly talk. So this property that we're going to be talking about is a 218 unit property, and it's located in South Florida in a city called Lake Worth. Lake Worth is in Palm Beach County. It's just south of West Palm Beach, north of Boca Raton and Delray, which have been exploding in the last several years. West Palm Beach right now, if you guys have heard about what's going on, there's billions and billions of dollars of new money coming in, of new development that's pushing the city and expanding. A lot of corporations are moving in. A lot of wealthy people are moving in as well. And Lake Worth has been like the silent sleeping sister that has been quiet, and now it's starting to move and starting to gentrify because of what's happening in the north of it and what's happening in the south. It's kind of getting sandwiched in between West Palm and Boca del Rey and Boynton. A lot of the expansion is moving north, and also from West Palm, people are moving south because they still want to be in the business hub of Boca del Rey and West Palm. So they don't want to leave that centralized area. So Lake Worth is getting an influx of people right now. The investment snapshots, as you can see, the property is high occupancy. It's about 95% occupied. There's a lot of below market rents right now. And that's one of the things that we're going to talk about, and what the value is in this property. You know, a lot of times we see assets that were built in the 70s, like this property. It's 100% concrete block. It's a bunker. It ain't going anywhere. It's got an incredible footprint. It sits on 19 acres. It has 22 buildings. And you can see that beautiful picture on top on the right. It's got its own private lake, which just is an incredible amenity for people, especially in South Florida, you know, visually and just nature-wise. Very, very quiet. We're going to talk about what we're going to do to the property in a light, moderate value add. There's not a lot of work that needs to be done to push rents up to where the market is right now. And as you can see, we have 218 units. The average market rents, again, the average, meaning from the lowest to the highest, is around 1877. The average market rent is 1865. There are rents that are about $300-400 below the average market rent, and that's going to be part of our plan. And the reason why right now is such a good time to get into multifamily is because of this tsunami of what did I just do? Sorry. Did I just take? Okay, there we go.
Oh, better?
Dwayne, maybe you can take over and switch the slides over.
Okay, you want next slide or?
Yeah, there you go. Perfect. Perfect. So, so right now the tsunami is that there's a lot of people wanting to sell their assets for many different reasons. One, they bought it several years ago at the height of the market. Now they're, you know, the value kind of went down. They have to sell. The loan is coming due. There's a lot of funds that are looking to dispose of some assets and move into different markets. So we're situated right now to really take advantage of this tsunami of what's coming down the pipeline. And with our track record of being in the multifamily space, you know, I've gone full cycle on about 13 deals in my career. And you know, the team as well has done billions and billions of dollars in multifamily with UBS and other banks and so forth. So how did we find Costa del Lago and why it landed on our desk is because we have great relationships with brokers. And it's very important to understand that these relationships mean money for us because the broker actually went to bat because I have a long-standing relationship with the broker who has this property, who's worked with the sellers in the past. And they saw that we can, you know, we have a gap between the current performance and true potential. That's our edge. So knowing the broker and him knowing me and we having a relationship, we were able to source this deal pretty, I wouldn't say 100% off market, but it wasn't blasted out. It was blasted out to their close network of investors, and we were able to get our LOI accepted. But we want to educate you on what we do and how we do it. Next slide, please. And there we go. Why relationships still win. Brokers call operators they trust. Like I said, we have a strong track record, reputation for certainty of close. And that's what a seller is looking for when they're picking a buyer, right? Can they close? Is there certainty of close? And that's what we were able to share with the ownership team that, you know, we have this experience, we have this track record, and we're able to come and close on deals like this. 218 units. I've worked on properties ranging from duplex, 4 units, 27 units, all the way up to 240 units, and throughout the career. So this is 218 units, falls right into our wheelhouse. And we like this type of asset because it's not 300-400 units, but it's also not 50 units or 100. It's just enough for economies of scale and to be able to manage the property properly with a strong grasp on operations. Yeah, next slide. So Costa del Lago is a well-maintained garden-style community with attractive curb appeal, and we'll show you some photos. Garden-style meaning that it's 3 floors. You know, garden-style is usually 2 or 3 floors that's spread out. It's not a high-rise. There's no elevators. It's a mix of classic and partially updated units, and we'll talk about that coming down the pipeline in a few more slides. It has a pool. It has green spaces. It's got a lot of parking. It's dog friendly. It's got a couple of dog parks. It's got a beautiful leasing house, a leasing office, and a clubhouse for people to come and to sit and to work if they need computers. It's got solid bones. As I mentioned, it's concrete block. It's not going anywhere. And a couple of weeks ago, I'm from South Florida. I live about 15 minutes, 20 minutes south of the property. I live in Boca, and we had a major storm. The hurricane that sat over Jamaica brought a lot of rain to South Florida. We had about 4 or 5 feet of flooding on Federal Highway. I mean, right where I was living, there were cars that were floating down the road. Just a lot of flooding everywhere. Thank God we didn't get flooded. But what we also found was that the property itself was okay. The current ownership, they actually put sump pumps down so that it would pump out water so there wouldn't be any flooding. And of course, we went back and we asked them, how did the property fare during the storm? They said there's no issues of any water intrusion or any flooding or anything of that nature. So we're very happy with that. And our plan does focus on upgrading the interiors and upgrading the exterior. And here you have, excuse me, a picture says 1,000 words, right? Look at the beautiful, that's on the top left, that's the pool deck. We have barbecue pits, we have verandas, we have tables with umbrellas, we have a beautiful pool. And look at that green space with the dog park, just beautiful. Now what we're gonna do is we're gonna paint the exterior to make it look a lot more warming. We're going to take this from a C+ to a B asset, meaning we're going to take the outside, we're going to really give it a nice touch of paint with highlights and different colors to accentuate the different tones of the property. Balconies, as you can see, and on the right side, this is the site plan, so you can see all of the buildings. Right, we have 22 buildings. There's the lake, there's the clubhouse, and it sits on a street that goes east and west called 10th Avenue North. In Lake Worth, you have 10th Avenue North, which is a major thoroughfare that goes east and west. And then just north of that, you have Lake Worth Road, which is the other corridor. Now, what's nice about 10th Avenue North is that it goes to I-95. I-95 goes from Florida all the way up to New York. That's the main highway. This sits about 4 minutes west of I-95, which gives people access to 95 to go to West Palm, to go to Boca, to go to Miami, very quick in and out, very, very easily. And again, you can see this picture, the outline of how really nice the property is guarded. We have the canals on the south side and on the east side. And then on the west side, we have single family communities. So there's high barrier to entry, which means that you can't really build anymore unless you demolish. And what's nice is that east of us, there's 2 Class A properties, one that's already completed, that they're in lease up, another one on the north side of the street that's under construction. Right across the street, where you can see where the red pin is. So right across the street, there's a new Chase Bank that was built. There's a new Chipotle. There's a new Chick-fil-A. There's new construction going on, and it just shows the gentrification of what's happening. There's an Aldi's 3 minutes down the block as well. And as you go further west down the road, and further west is towards the top of the page. As you go further west, it's just single family communities. So there's really nothing that you can build over there. And this gives us really good bones for either redevelopment down the line. If we want to, tear this down or sell it to a developer down the line. There's a lot of exit strategies that we can do when we're looking at a property like this. And that's why we like it, because there are multiple exit strategies. The landscaping is beautiful. It has a great unit mix of 1 bedrooms, 2 bedrooms, and 3 bedroom units. And it's not a lot of work to upgrade the interior units, which is really what we enjoy. We also have about 7 roofs that were already that were already replaced, which leaves only 15 roofs to be replaced, which when we go and we do our numbers, when we create our business plan, we've already incorporated the replacement of these 15 units. So that's what we look for. We look for high barrier to entry, which we have over here. We look for areas that are gentrifying, we have over here. We have the new construction across the street, the bank, the restaurants. There's a new hotel that's being built also behind Chase, behind that top corner of the property. Across the street, there's a new hotel. So there are signs that there is movement, there's gentrification, there's things happening in the area, plus the current occupancy of the property. Now, I had a duplex on the west side of Lake Worth as well, and it was a 2-bedroom, 1-bath, 2 units of 2-1. Nothing exciting, didn't have a beautiful lake like this, didn't have amenities, and we were pushing rents between $1,900 to $2,000 for that duplex. So imagine when you're here, what we can possibly do to this property. Now, when we are looking at the upside, we're going around and we're looking at the comparables in the neighborhood. What are the comps doing? What are other properties, similar age, similar unit sizes, similar everything? What are they getting for their rental rates? And is it comparable to what we have? Next slide, please. And as you can see, these are some of the units, and we have here black appliances. So one of the things that we're going to do, which the ownership has already done, which proves a little bit of the upside, is take the black appliances, and as you can see on the bottom picture, there's really only 2, even on the top. There's the stove and the refrigerator. They've taken those and they're replacing them with stainless steel, and they're charging an extra $25 to $50 just for that. What we want to do is go in and put beautiful backsplash in the kitchen, subway tile backsplash. I don't know if you can really see the sink. It's just a basic sink from Home Depot, but we're going to replace it with a gooseneck faucet and possibly put a dishwasher in the units. And maybe even if you look at the right, you see that hood, the vent with the box, with the cabinet. Remove the cabinets and even put a microwave that has a vent. Give more value to the residents when they're moving in. Of course, we're going to increase rent. So that's what we look for in these types of assets when we're acquiring them. We're also thinking, we also look to say, what else can we do to add value to the interior of the units? Well, today we have the advent of keyless entries, Wi-Fi thermostats, right? With the phones. So we'll be testing those things out to see, are people willing to pay more for that type of amenity? And as we start progressing and doing those value adds, we may even put quartz countertops to see, can we push the rents even higher? Will people want those types of amenities in these units? And that's what we look for, and that's what our plan is. We're also part of the upgrades, and here we're talking about it, part of the upgrades also is to go in the 2-bedroom and the 3 bedrooms. The master bedroom has a big walk-in closet, and the wall is shared with the bathroom. So all we have to do is cut open a square in the closet on the drywall, add some faucets, connect to the water pipes that are inside already from the bathroom, and now you've got washer dryer hookups, which you can add even more upside to the units, right? So again, key upgrades: new flooring, updated counters and fixtures, stainless steel appliances, meaningful rent uplift while staying below Class A pricing. Now, one of the things that we're doing here, because the ownership, and this is what we look for as well. Like, why would we want to buy a property like this? What is the upside, right? That's what we do when we look at these types of assets. We ask the question, what is our value play? How are we going to add value, and what can we do? We looked at the rent roll, and we saw that while it's 96% occupied, the current ownership of this particular asset hasn't pushed rents on a lot of the units. They've pushed rents on some, so we know that they can push rents. It's called proving the upside. But what they've done is they've left the majority of the units, the 1 bedrooms, 2 bedrooms, and even 3 bedrooms, way below the property market rates. So the first thing that we're going to do is we're going to go in and we're going to push the rents to where current market or property rents are right now. And that's the first upside. And then the second upside is to go in to do the interior renovations and the exterior renovations that we talked about, painting, putting the accents outside on the buildings, making that warm feel so people can really feel like they're coming home. We're gonna spruce up the lake area, maybe put a walking path, put some more, tables and picnic benches and barbecue pits along there so people can really sit outside by the lake and enjoy having a barbecue. Here, perfect pictures. Thank you. Right? You have pictures on the top right. That's the clubhouse. That's the leasing office, the pool. Imagine walking outside of your backyard, going to the lake, popping open a barbecue with your friends and family, having a nice place to sit, covered. It just makes for a warm environment. And on the top left, you can see there's a little dog park area, so we'll make more dog parks. That's just adding value so that people will want to come to live in our community. And again, it's not difficult to do these types of assets, of these upgrades. That's what we do. Very plain, very simple, nothing too exciting or ridiculous. We're not building rocket ships and sending them to Mars. Very simple. The difference is that we have a team that has been doing this for years, and we're very exceptional at making sure that we underwrite correctly, we get the right market rents, and we do the value add, and we stay on top of the property management to make sure that they're hitting our numbers and our targets. So what makes this deal undervalued and how we underwrote it? High occupancy. Great. That's what we look for. We also look for properties that sometimes may have low occupancy, but then we have to really dive deep and find out, why is it low occupancy? Is it because of poor management? Is it because of poor ownership? Or is it truly the neighborhood that is pushing that occupancy low? Here we don't see that. We see that it's a stabilized asset, but there's value in pushing the rents and doing the upside. Interior finishes and amenities not aligned with what residents will pay for. Absolutely. Modeled realistic rent premiums. That's what we do. We're not going out there and going above the Class A properties. We're still below Class A. So for those people that want to live in a nice community but don't want to pay Class A property prices, this is where they're going to come. All right, our exit cap rate, our rent growth and vacancy assumptions have been stress tested for the downside, and we've built in reserves and contingency for capex and operations for all of that. So that's how we underwrite our deals, and that's what we look for in undervalued assets.
Nisa, did you want to take a look at the high level numbers for the next slide, or you want
Yeah. Let's absolutely, let's take a look at it. So we have on this particular property, we've got an accepted offer of $48 million. The total equity is $22.1 million. We've gotten initial debt quotes from several lenders, and the rough estimates have come out to about $32 million at a 5.51% interest rate. And as you can see here on the left, the LTV, the loan to value, is about 67, and the loan to cost is 60%. That's how much the lender is going to give us. Our projected returns, okay, the cash on cash is about 11.59%. The internal rate of return, which is what we usually target, is between 17 to 18%, which is phenomenal, especially in South Florida. And we're going to talk to you a little bit about what's going on in South Florida in the upcoming slides. There's this publication that's called CoStar, which is the #1 publication in the multifamily world that talks about markets, cap rates, what's going on. And it takes the whole scene of the area and it projects moving forward what cap rates, what market cap rates are going to be doing over the next several years, and we'll cover that in a minute. And our equity multiple, meaning after we hold it for 7 years now, the plan here is to get into financing, acquire the property, push the rents, do the renovations, and then in year 3, once we stabilize the property with the new added value and market rents, we're going to refinance the property and we're going to hold it for another 4 years. And that's where we come up with a 2.8 to 2.9x multiple. That means that if you give up, when you invest, let's say $100,000, you're going to get 2.8x on your money. That is a phenomenal return, right? And again, targets are projections and not guarantees. And again, this is for informational purposes. We're not offering to sell any securities. We don't have the property fully under contract yet. We have an accepted offer. We're still negotiating. But for us, we're looking to educate people on why South Florida and how we buy up properties and what we look for and what type of returns in general we offer to our network of people that we have relationships with, right? So again, you can go to the next slide. South Florida. Tons of people still moving to South Florida. The market is booming. Okay, you hear a lot of things going on. Oh, Miami, Tampa, this and that. There's still a lot of money coming in, especially to West Palm. This property is 10 minutes away from West Palm Beach. It's a suburb. You can consider it a suburb of West Palm, right? In a growing gentrifying pocket of Palm Beach County, close to major employment centers, schools, and healthcare. By the way, we have Florida Atlantic University, which is in Boca Raton, which is a 15-minute, 20-minute drive from the property. We have Lynn University, which has 30,000 students. We have Lynn University, 15-minute drive as well, 5,000 students. We have Palm Beach State College, 20 minutes from the property, also 30,000 students. And then there's Palm Beach College, which I think has another 5,000 or 7,000 students. So in a 20-minute drive, you have universities, 4 universities that have almost 70,000 student population. That's huge. FAU doesn't have, there we go. FAU doesn't have places that they're putting up students in hotels because they don't have enough student housing. And the same with Palm Beach State. So imagine now we can now also attract some students to come live with us, but we can't have more than 20% of the population of the property being students. That's just against the requirements of that. But what it means is that as these universities grow, you have professors, you have the staff, you have HR, you have the registration office, you have all of the employees that work to maintain the university, the staff, the coaching staff, the cleaning staff, all these people, they need a place to live. And we're 15 minutes away from all of these universities. That's key, huge. There's 65 total major headquarters in Palm Beach County. 40 of them are in Boca, and the rest are in between Boca and West Palm. And there you go. Look at that. You have Florida Crystals Corporation, 2,000 employees. All right, that's the sugar company. Right, U.S. Sugar, 1,300. Cheney Brothers, 1,000. Look at up. You can go Palm Beach County School District, 22,000 employees. Florida Atlantic University has 6,000. Palm Beach Board, 5,000. You can go through this on your own, but you can see the amount of industry that's here in Palm Beach County and how many employees. And it's just growing and growing and growing. And we also have in Boca, the Bright Line, which is the fast train that links Miami, Fort Lauderdale, Boca, and Orlando. And now they're also going from Orlando to Tampa. So people will be able to move around for business a lot quicker and a lot faster, making it just a great place to do business, right? And here you go, Scripps Research Institute, VA Medical Center, Wellington Regional. These are all medical centers, right? And look where our property is situated. HCA Florida JFK Hospitals, Good Samaritan Medical. Look at all these beds. They're huge, 400 beds, 493 beds, Delray Medical Center. Doctors, nurses, staff, they can all work in these hospitals and medical clinics and live in our property. We're situated in a prime location, and that's what we look for in a property. We look for location, location, location. And these are if you look on the top, the left side, The bottom picture, that's the Avery, I believe. That is that's a hotel, but right behind it is a Class A multifamily property as well. The picture on top, that's Class A property as well, and they're under construction. What does that tell you? That people are moving in. People are moving. You have the brand new Chase. You have Chipotle, right? All of this is here in the now. It's not something that is projected to happen. So what we're doing is we're looking for markets that are already gentrifying, that already show signs of movement, and we're moving in and we're capitalizing on the movement that's happening. And you'll be able to read that. AAA, what is that? 444 billion. Lots of things going on here. Lots of things going on, right? Recent firms relocating and expanding in Palm Beach County, right? All of these, JP Morgan, New Day USA, what is that? I can't really read that. It's a little, Dwayne, can you read those?
Yeah, so you got my Bamboo Hotel Planner. You have Colonial Capital's headquarters here, New Day USA, JP Morgan, Kanye Anderson. So yeah, several large major, like a lot of financial. Of course, we're seeing a lot of the migration from up in the Northeast. It's been a trend for quite some time, but you see, politically it's pushing a lot of people in this area and employers because of the favorable taxes and business-friendly environment. So that's kind of some more positives to add to that list.
Absolutely. Yep. All right, next slide, please. So the debt structure and managing the downside risk, moderate leverage. Again, you saw 60 to 67%. It's a fixed rate structure to reduce volatility, right? We're not going in with a floating interest rate, and that's what got a lot of people in trouble in the last years. We've got ample reserves and operation contingencies. We've done the stress test. One of our partners in the team, there's been we have two CPAs. One has been a CPA for the SEC in the compliance division. Another one, and their husband and wife, Karen and Doug. Doug has been a CFO for Fortune 500 companies, taken companies public. So he understands debt, understands movement of capital, how to create business models, how to be conservative, how to create projections, how to understand and do stress tests, right? So that's who we have on the team, and we pride ourselves on the people on the team, right? And yes, and cash flow first and upside second. That's what we focus on. Yeah, next one, man. This is great. If you guys have questions, again, feel free to, who will be doing the property management? All right, let's take a quick second. And how many units do you estimate to upgrade in years 1 and 2? All right. So we're working with a few property management companies. The current management company is Cushman and Wakefield. So we've talked to them. We've talked to a company called MMG, Meridian Management Group. I've worked with them in the past in Atlanta, and they have a foothold in Florida as well. We're talking to several companies that were referred to us by the broker, the contact that I know. How many do you estimate to upgrade in years 1 and 2? Our goal is to renovate 80% of the units. And the reason why we want 80% is because when we go to sell the property in year 7, let's say, or 5, 6, 7, during those time periods, we want to leave meat on the bone for the next buyer so that they can come in and they have some value add as well, right? We don't want to do everything because then we're going to limit the buying pool, right, when we go to exit. So we're going to do about 80% of the units, and that's how we underwrote the project, right? We don't want to do all the units because then buyers are going to say, well, what's in it for us? We're not just going to buy a property just for the sake of buying it. They're looking at it the way we're looking at it. What value do we have, right? And why are we buying this? Okay, so that's what we're going to be doing. We're gonna look to do all of this within the first 2 to 3 years, and then we're going to refinance. So why this timing matters, the 25-29 window, right? We're in a repricing cycle. Okay. We're now going into a buyer's market, and that's what we want. right? Higher rates have forced more realistic pricing on quality assets. Interest rates have gone down now as well. However, the damage was already done with people buying variable interest rates, with people buying at very low cap rates, which means the property was very expensive. And now they can't refinance because the value isn't there, because cap rates went up. The values of properties went down because interest rates were so high, right? Now interest rates are dropping. There's a tsunami of bad debt, distressed assets coming to the market. People have gone through their cycles and now need to sell. So we're now taking advantage of this beautiful storm that's coming on, right? Again, many owners are facing low maturity. Stronger markets like Palm Beach offer rare chances. So this is, last 2 years, we've been looking to see what's been going on in the market. We're not buying for the sake of buying. We're buying for the sake of creating value and creating cash flow and appreciation for our investors. But it's been cash flow first. That's what we're looking for.
And we have another question. I'm sorry.
Yeah.
We have another question. What are the disbursement plans and the frequency?
So the way we like to do when we close on a property, what we like to do is we like to complete that quarter, hold a quarter, and then start distributing on a quarterly basis. Now, what happens is when we go into a property, we like to, before you know it, 2 months have gone by, 3 months have gone by. So we like to go in and get a hold of the property, right? Make sure everybody's paying rent on time, stabilizing, renegotiate some vendors, make sure the property manager has a feel for the tenants and the ebb and flow of the property. Every property is different, right? So we got to really understand the property and get a good holding of the property and get our coffers filled so that we can now distribute make distributions. Is there another question there? Did another one pop up?
Yeah, so we just have a statement from Chris. He was just kind of adding on to the previous slide about Lake Worth. Chris is also from this area, so he has some experience as well. He had mentioned that there's about 105 million, 250 room Grand Hyatt, oceanfront hotel, on beach parking, a $95 million investment, another Hyatt conference, a Jack Nicklaus golf course valued over 22 million. And then he mentions a couple other projects. So it's just a lot of investments that's going on. Florida, of course, this part of the region has been extremely attractive, but as Nissan been in this market for well over 20 years, has been seeing kind of the gentrification as well as the additional investments, and we kind of foresee that's continuing to happen.
Yep, and as Chris says, beyond the impact of the permanent facilities, the construction itself is expected to add $481 million to the local economy and create 1,857 new jobs. That's huge. That is a huge influx of capital into this market, right? So yeah, we're really excited about it. But again, this is what we look for when we're going into a market, and this is what we look for when we're looking for different types of assets. I think we went over this already, right? So again, cash on cash, 11.59%. IRR is 17 to 18%. That's the target. What we do also, when we go to present the offering, what we do is we create a cash scenario of what would happen if we held it for 5 years and sold it at a higher cap rate, or held it for longer and sold it at this cap rate. So you can actually see and get a very holistic picture of what goes on the property. Now, the way, and you can go, you can move forward.
Yeah, so kind of here, and I just have one far as because we do have some newer people that were introduced that are new to syndication. So we have a slide on just kind of in general how that process works. Or would you like to talk more about the market, or we can save that for the end? However you like.
Sure.
To proceed.
Yeah. So what is the cap rate on the property? I believe the cap rate is a 6.1 or 6.2 going in cap rate. The market cap rate right now, the market cap rate in this area for these types of assets is 5.4. And we talked about CoStar, the multifamily publication that is the leading publication for all multifamily across the country. They're claiming that their projections is that the market cap rate is going to compress, is going to go down, which means the value of properties is going to increase. The value of the property is going to go up. Right, so it's going to go from a 5.4. They're saying that it's going to be under a 5 cap by 2029, which is when we're looking to, maybe exit or refi or do something in the property. Right, so now the model that we acquire these assets in is called a syndication model. It has two classes of ownership. It has what we call LPs, which are limited partners, and limited because they have a limited say in the operation on the day-to-day operation, and they also have what's called a limited liability. So, for example, if a property goes sideways and there's a foreclosure or whatnot, the LPs are not affected. You don't get dinged on your credit. You don't have that on your credit history. They don't come after you. You're protected because you're an LP, right? LPs are the capital investors that come into the property. The GPs, the general partners, people like Dwayne and myself and Karen and Doug and the possibly Chris. We're the general partners. We're the people that are running the property on a day-to-day basis. We're the people that are signing on the loan, the guarantors on the loan, right? We're responsible if anything should go sideways, and we're responsible for handling the execution of the business plan, right? So that's how it's structured. It's general partners and limited partners, right? There's also accredited investors and sophisticated investors. And, we haven't, and we usually go out and when we're doing a large raise like this, maybe we'll bring in accredited investors only, or, we haven't figured out, but the structure is a syndication and you have your general partners and your limited partners. And usually we split the cash flow and the equity, the profit, with the limited partners. Usually the limited partners get anywhere between 70 to 80%, and we get 30 to 20%. In this model, I believe we're doing an 80-20. 80% of the cash flow and 80% of the equity is going to the limited partners, and 20% is coming to the general partners. And the GP, we eat last. Our limited partners get paid out first. So it first goes, the lender gets paid first, then the limited partners get their distributions, and then the general partners, we get our distributions. And that's what you see here, a preferred return. Preferred means that the LPs get paid first, right? Now, there's also some tax benefits and different things that we're going to do. As you can see on the bottom, we do what's called a cost segregation report. On the day of closing, we hire a cost seg company, which I have relationships with, one of the top companies in the country. They're out in West Palm. He's one of the largest employers in West Palm Beach. He's a good friend of mine. I know him for 15 years. They do the cost segregation on our properties. They've been doing it on all of my properties, from multifamily to commercial to hotels to single families to short-term rentals, all of that. What this does is it's actually an engineering report. They come and they give us an engineering report, and it breaks down the different components of the building. The actual structure, right? If you've ever bought a property and you go to your CPA will normally depreciate your asset over 29, 30, whatever years it is, and straight line, they call straight line depreciation and so forth. The problem is that, let's say the air conditioning system in the building depreciates over 5 years. So why would you want to extend that depreciation for 29 years? So this cost seg report is an engineering report that breaks down the components. We give that to our CPA, and then they take the depreciation and they boost it into the first year. So now we take that depreciation and we flow it down through the K1s to all the investors. Now you take that depreciation, or you take your K1 and you give it to your CPA, and they say, well, you invested $50,000, and this is just an example. I'm just making up numbers here. $50,000, but you have a loss, a paper loss. You take that paper loss, and your CPA can put that against your income, depending on your structure and all of that. So speak to your CPA about that, and we can help with that as well. We can have our CPA talk to your CPA if there's any questions. But that also helps to increase returns throughout the whole period, because now we can depreciate the asset in year one. And if you don't need the depreciation, you can offset it to next year and so forth. Now, again, not a CPA, consult with your CPA. Go ahead.
Perfect. Next question was going off of this same slide, difference between accredited and sophisticated investor. I know that you're still setting up the potential structure on this deal forthcoming, but can you just explain kind of the difference between the two investors? And I know they have a kind of a SEC definition as far as compliance and who can and cannot invest.
Right. So an accredited investor is someone who makes $200,000 solo, or $300,000 combined with their spouse, or has a net worth of $1 million or more excluding their primary residence, or is licensed as a Series 7, 63, and some other licenses. That's an accredited investor. A sophisticated investor is someone who doesn't qualify as an accredited investor on the financial aspect. However, maybe they've invested in stocks, maybe they're a business owner, maybe they have some sort of, they're sophisticated in the knowledge of investing, right? That differentiates them from between sophisticated and accredited investor. Now, there's two different types of offerings. There's a 506B, as in boy, and a 506C, as in Charlie. The 506B is think of it as a friends and family. You have to have a pre-existing relationship with the person before you can make the offer to the person on the property to invest. The 506C, now with the 506B, you're allowed up to 35 sophisticated investors and an unlimited amount of accredited investors. A 506 now, and by the way, the 506B, you're not allowed to promote it. You're not allowed to do email blasts. You can't, nothing. It's a one-to-one communication, and that's why you have to have a pre-existing substantive relationship with the person, right? You need to know, who they are, what they do for a living, what their investment history is. Can they afford to lose money? Because this is an investment, just like any other investment. So that's the 506B. A 506C, as in Charlie, you can go out on the highway and you can put a billboard and you can say, who wants to invest in my deal? This is for accredited investors only. And you do not have to have a pre-existing relationship, but you cannot bring in sophisticated investors in a 506C. It's only accredited investors. So that's the difference between the two offerings and the type of offerings. We haven't decided which way we're going with this. We'll figure it out later on. That's not that's just a small cog in the wheel right now. But yeah, great questions.
Perfect. And I think one came over in regards to as we've seen over the past couple of years, as far as like storms. You had mentioned there was a storm that came over from Jamaica that caused flooding, but we did see some substantial decrease in insurance, which used to be a detractor to invest in Florida. I note that Doug had mentioned like insurance costs has adjusted recently. Can you kind of touch on that point for people that has a question on that?
Right. Yeah. So we've talked to a lot of insurance companies. We've had them size the properties. We've gotten insurance quotes, actual insurance quotes. We've even gotten actual real estate taxes, right? A lot of times people just estimate them. We call up the appraiser's office. We find out in Florida, upon acquisition, the following tax year, the basis, the appraised, not the appraised value, but the tax base is the purchase price. So they could have bought it for 20 million and their taxes are based on 20 million, but when we buy it for 48, our value or our tax base goes to 48 million. So you have to know that when you're going out and buying properties in specific areas, because if not, and you're just taking a guess with taxes and you don't know how it's being assessed on a yearly basis, you could lose a property because you didn't analyze it correctly. You didn't adjust for taxes moving forward. So one of the things that we do is we communicate with insurance brokers on current insurance rates. And like you said, Dwayne, insurance rates started to go down. We're hearing, to drop by 20% or whatnot. That's hearsay. But we have multiple quotes from multiple agencies. We reached out, Doug, our CFO, reached out to the Palm Beach County Appraiser's Office, got exactly the numbers on how and the way they assess properties, and we built that into our model so that we know exactly how the numbers are going to turn out. Yeah, next slide. And let's move along pretty quickly here because we're getting close to 9 o'clock. So let's go back. Where was that? Yeah. So who this opportunity is for and who it's not for. Again, you know what? Let's skip this because we're not offering a securities right now. We'll talk about it. Once we move forward, and we start putting this out to the public when it's time with properties, what we do is we create what's called a PPM. We go to the SEC attorney because we're compliant. We have the SEC on our tail for regulations because remember the limited partners, the investors, you're not actually taking ownership of the property. What we're doing is we're buying or we're investing in a company. We're buying shares of a company that owns the property. So imagine like you're going out there and you're buying a piece of Tesla. You don't own the actual company, right? You're not going out there and buying the company. You're buying a share, a security in the company. And this is what we're doing now as well. You're buying a share in the company that owns the property. So we're regulated by the SEC. So we hire an attorney that is specifically SEC, which is a federal attorney, right? It's a federal law. And they create what's called a PPM, Private Placement Memorandum. This is a booklet that talks about the investment, talks about who we are, what we've done, what this is. It's basically the doom and gloom. Tells you that this is an investment, high possibility of you losing your money. This is a risk. This is just to make sure that you, as an investor, are covered. CYA, right? Cover your backsides. And that's what this PPM is for. It's to protect you and to protect us as well so that everybody knows what we're doing and what we're getting involved. It breaks out the business model, the plan, the projections, everything. So you know exactly what's going on. I recommend reading through it. I recommend sending it to your attorney, having your attorney read through it, having your CPA read through it so they all know and understand what you're getting into. Then there's a subscription agreement, the subscription booklet that comes along with the PPM. That is just information. That's a booklet of information. You can take ownership in your shares in your personal name, in an LLC, in a C Corp, in an S Corp, in your nonprofit, in your 401k, whatever retirement vehicle you have, in any form. You fill that out, say, I want my shares in this entity. You give your information on that entity, your wiring instructions, all of that in that booklet. We take that. We then evaluate it. We say, okay, this person qualifies. We're okay. And now we accept you into the offering. And now we move in. And now we partner up on these projects together. And that's basically the very simple, high level of how we do this. So again, let's reiterate, right? We go into markets that have high barrier to entries. We go into markets that are emerging or pre-emerging, that are gentrifying, and we showed you that this area is gentrifying with the new construction, with the jobs that are coming in, the hotels that are being built, the universities that are close by, the medical centers that are going by. Now think about it. Hotels, Hilton, Hyatt, whatever the names of these companies were. Do you think they're going to go into a market without doing market research of how many people are coming into the area, of how many travelers? Now think, if hotels are being built, that means that more planes and more tourists are coming in. That's more service-oriented jobs. More people coming to get hired for those jobs. Where are these people going to live? in our place, right? Now, these blue collars aren't going to go live in the Class A properties. They're going to come to ours, the B properties, where we've upgraded it and given them a beautiful place to live for a very, very long time. And that's the type of areas that we look for, and that's the type of property that we go in. Now, this asset is stable in occupancy. However, the rents are low. So all we're doing is we're coming in and we're pushing the rents. Very simple. Where are people going to go? Nowhere. There's really nowhere else to go because we're just taking it to what the market is doing. And then we're going to add the value and push it up a little bit more. And that's that's the play here, right? Easy. Appliances, already been proven. Backsplash, very easy, very cost effective. $50 for the, $50-$70 for a gooseneck faucet. Easy, added value. Washer dryer hookups, added value, right? Microwave instead of a vent, added value. Giving it a beautiful look on the outside, added value. Oh, another thing that we didn't talk about is, you ever see those green, ugly dumpsters that they have in parking lots in these apartment complexes? Our plan is to get rid of that and to have what's called valet trash. A nice basket outside the door. People come, they put their trash in there. Somebody comes a couple of times a week, picks it up and takes it for them. Like this, people don't have to walk in the rain and in the heat and dump it and the smell and the disgust. We're getting rid of all of that. And that's how we add value to the community. And that's how we acquire assets. And that's the projections and what we do. Any questions? Yeah.
Yeah, we got one more. It was in regards to the current and projected NOI. I don't know if you wanted to. I didn't put that on the slide deck. I don't know if that's something that you wanted to pull up.
So the current NOI is about $2.993 million. I don't recall the projected NOI moving forward. I don't like to keep those numbers in my head because if I give a wrong number, then it's wrong. But we can definitely share that with you. Doug, if you know that answer, if you're on, or Andre, maybe you guys can type it in. What is the projected NOI? At this point, is it at the point where I can no, we're not. We're not offering securities here. We're not doing anything. This is just strictly for educational purposes only. Okay. And so we're just here doing this as an educational format to show people who we are, why we like these markets, how we enter them, how we get these types of assets. And it's through broker relations. A lot of these projects that come to us are through broker relations. We have another project in Northwest Arkansas, for example. High barrier to entry. There's a multifamily space on this side. There's buildings on the other side. There's woods on the back side. Again, barrier to entry. University of Arkansas is 15 minutes from that property as well. Broker relations. That property was given to us off market. We've got that property under contract as well. So the way we source is through off market, sometimes on market, but it's through broker relations. And being in the business for the last 16 years, I've accumulated a lot of relationships. Dwayne has accumulated a lot of relationships going direct to sellers so that we can get off market opportunities. We have 1 out of 400 applied demographers on our team. And if I may say so, I think he's top 5, if not the number 1 demographer in the country. And he was at the event, and you met him, Dwayne Scott. He's part of our team. He gave us a double thumbs up on this market. He loves the market. He's like, yeah, man, this is fantastic. This is a market that we want to be in. So when you have someone who studies flow of people, demographics, influx, outflux, why are people coming, what groups of people are moving, and he gives you 2 thumbs up, you know you're in the right place. Projected exit NOI. So when we exit the property, right, in year 7, our exit NOI is $4.2 million. Okay. Now we're buying it at a 6.2 cap rate, I believe. By the time we go to sell, the cap rate in this market should be about a 5.1, according to CoStar. okay? And we're going to sell it above market cap rates, which means that we're not even going to go as low as the market cap rate. We're going higher than what the market cap rate is telling us it is. So that's us being even more conservative. And that's what we look to do. We look to have our very conservative underwriting to make sure that, well, what happens, right? What happens if there's another COVID? What happens if this? What happens if that? We've tagged all of that in to our numbers and our projections, and that's how we do it, right? Exit cap rate is 5.4. Yep, and the market cap rate is going to be a 5.1. So you can see how we're being conservative in our underwriting. But again, this is what we do when we look at different markets. This is how we analyze a new market to get into. This is how we put a check mark on what type of assets. Is it a heavy lift on the value add? Meaning, what do we have to do? Do we have to put on? Is there foundational issues? Is there flooding issues? Is there mold? We saw a property. We walked a property where the ownership told us that the units are great. Interior units, all you got to do is upgrade them, kitchen cabinets, countertops, appliances, blah, blah, blah. Easy. Okay, fantastic. We walked in and we saw black mold. All the hot water heaters were from 1980s. All the HVAC systems were from 1980s. They had cockroach infestation everywhere. So now that's a heavy lift because now you got to change the electrical on the property. So that to us was a very heavy lift, which is okay. But we had to go and retrade. We had to go and renegotiate the purchase price because the sellers weren't forthcoming. We've walked this property. Dwayne walked this property. Doug and Karen walked the property. Scott walked the property. The majority of the people on our team, Chris walked the property. Greg walked the property. A majority of the people on our team have already walked the property. Now, obviously, we didn't see every single unit. We're going to do that once we're under contract and under due diligence. Yeah, our pleasure, Pam. Thank you so much. Anybody have any last questions? And again, thank you so much for being here. Again, educational purposes only. We love to do this so that you guys know who we are, what we're looking for, and when the time comes, if you're up for it and you want to talk about investing with us when the offering is available, we'd be more than happy to have another private conversation and discussion. And that's how you can reach us right there. Multifamilyinc.com/call. Set up a call with me. That's my email. And that's our website. You can go visit us. You can see the team. You can see Andre. You can see Scott and Karen and Doug and all of us on the team. Feel free to reach out to us with any questions, comments, or anything of that nature. Oh, no worries, Pam. It's all good. Appreciate you being here. Anybody else have any questions? And again, you guys, thank you so much for taking the time out to be here with us to learn about who we are, what we do, and how we do things. And hopefully we'll see you guys soon, and we'll reach out to you once we have this locked and ready to go.
So, any last questions? I know a couple people that I spoke with earlier were kind of talking about the numbers and stuff. I said it is preliminary, so we'll reach out directly and probably have some subsequent presentation to go deeper into the numbers, as well as I think Doug is on as well. If anyone have the high level stuff that they wanted to kind of send over to the team, or Nissan want to carry that. But other than that, I appreciate you guys again, and thanks for the support.
Yes, thank you, everybody. Thanks for being here.
Okay, let me check the last one. Okay, I think that is it. All righty. And replay will be available. We did live stream this, so I will have this out tomorrow morning, the link. And also reach out again if there's any additional questions and set up any one-on-ones if we want to kind of talk in depth. All right, perfect. All right, thank you.
Thanks, everybody.
All right, take care.
The recording has stopped.
I think that was it. Alrighty.
All right.
All right, thank you, Nitan. Yeah, I was trying to follow your flow because they said when you couldn't click it, so I was trying to follow and make sure I got all the slides there for you. So hope that went
No
okay.
worries.
I didn't know
Absolutely.
how in depth you wanted the presentation because I knew that he was keeping it high level. That's why I didn't add any numbers or any of that stuff. So
That's great, man. All right. Let's close it out and we'll say goodnight to everybody.
all right, sounds good. All right, take care. Yeah,
Have a
we're
good night.
already into the stream. All right, take care. I'll talk to you soon.
Yep.
Okay, bye-bye.